Hi guys, Harry Otis here. I'm a professional trader for 20 years now. Started my career in 2005, still alive in 2026. So today, we're hovering at the highs. It's Wednesday, the 12th of August. Basically, looks like a bull flag forming on the S&P 500. Okay, today, the big news is inflation, but I would like to talk about Wendy's. Okay, we saw that Wendy's stock was ripping today. So how would I play such a stock that is in action, like it's in play, and there's a chance to make money off of it, okay, because there are potential takeover rumors on it. Okay, we'll get to Wendy's and how I would play it, but first let's talk about the technical picture. It's still bullish, bull flag, as we said. Okay, bull flag, nothing has changed. The technicals are bullish, and the sentiment here is still greed. Yet this is what I like. We are recycling the stock price back to neutral. This is good. This is what you want to see, the broad market catching up. Okay, yet there's still a lot of calls being bought. Okay, that's what gives me pause. The only thing that gives me pause, because we can still go to extreme greed. We might go to extreme greed before the calls get destroyed. Who knows? But so far, the sentiment has still room to run, and we are forming a bull flag. Okay, so what was the big news today? Inflation. Okay, and inflation is what kept this market up, because basically we had the CPI come in at 0.1%. They were expecting 0.1%. Last month it was negative because oil was really, really down. But today, I suspect it was up because oil was up. If we look at U.S. oil, you can see that it was up for the past month, whereas the previous month you can clearly see a downtrend. Okay, so I think that as oil goes down, and I think will continue to go down, inflation will get muted. I like the fact that oil went up and inflation is still low. Okay, this just goes to show you that there's no real inflation pressure in the game, except for the price of oil. This starts going down, it's over. Okay, like there's going to be no inflation. Okay, so let's get back to the SPY and well, before we get there, we also had the Fedwatch tool, because as inflation print goes down, September meeting, 60% chance no hike, 40% chance was a hike. This was reversed before the inflation numbers and before the job numbers. Okay, guys, I'm telling you, I expect no hike this year. Okay, and like I said in my Twitter, I expect the next move for the Fed will be a rate cut, not a rate hike. Okay, and remember, for all of December, okay, now we're at a 25% chance of not doing anything, 44% chance for one hike. Okay, this was at 18 yesterday. Okay, we're getting there. We have a long way to go before it gets to 70% or whatever. Okay, the market could really rip as the odds of a standing pat or no hike increase, and these guys go down. Okay, I have never seen the Fed increase rates when you have a negative job print. We had negative 23,000 jobs last month, and it could continue this month. Okay, there's no way they're going to hike in that scenario. Okay, so this bodes well for our thesis. Okay, so before we continue, let's get to the main event, Wendy's. I like to talk about Wendy's. Okay, so today it ripped. Okay, but let's put it in context. The stock has been in serious decline for a long time. Okay, a long time it's been in a downtrend. Okay, but now all of a sudden, and it was previously too right here, they were right here, meaning that a big volume increase in June of this year, June 25th, because of takeover rumors. Yes, so we do have more takeover rumors. Okay, so Wendy's stock soars on report Trian Partners prepares bid to take the company private. Okay, so shares of Wendy's surged. Nelson Peltz's Trian, I don't know how to pronounce it, Partners wants to take over the fast food chain, take it private probably, and the stock jumped 12%. Okay, so that's what happened today. A big move. The stock is up 15%, actually more than 12% on takeover rumors. Okay, so how would we play it? Okay, what is a good risk reward to play this stock? Okay, so first let's look at the fundamentals. Okay, this is Wendy's on FinViz. Okay, the company has guided lower on earnings. Okay, but it is a restaurant company. It makes about 5% margin. Okay, net. That's not bad for a restaurant. Okay, but here the PE ratio is 13. Okay, this is noteworthy because the stock has been in a downtrend for a long time. It has a lot of debt. Okay, but it could still survive sort of in the short term because it has good liquidity, but it has a lot of debt to equity. Okay, this is why there's a lot of trouble. Okay? And it is a stock that is in trouble. Okay, but if you look at the restaurant industry, okay, the average PE is about 25, 26. So maybe double this price, this PE. So that could mean, we don't know, that maybe the price is going to be at least double or maybe 50% to 100% higher than what it is right now. Okay. So let's go to the chart. 50% higher, 9,450 might be around here. It might get taken over, if anything, $12.50 to $15 range. Okay, that would be a logical sign. So how would we do it? Playing options. Okay, because I like to play it using options. I don't like to take a chance with a stock, because remember, this stock, I don't like it. You're just basically betting on the takeover. Okay, and the takeover might be between 12.50 and 15, let's say. Okay, so how would we play it? Let's go to option strat. Okay, I like to play the spread. Okay, so this is, it's the stock traded at 866. Okay, so let's say it stopped trading and we're going to trade it right now. How would we enter it? Okay, this is buying the 9 call and selling the 9 call. It's a straddle. Okay, but it's done on, it's a calendar. Okay, it's a calendar call straddle because it's done in different time periods. Okay, the short call expires on the 28th of August. Okay, and the long call expires on the 18th. Okay, so you want to be able to take advantage of here. If you look at the August 18th has 71% implied volatility, and the August 18th has 62. So you want to take advantage of the fact that this short option will expire, maybe worthless. Okay, you don't know. Okay, but I don't like this straddle payoff. Okay, because the max loss is 35, and if it gets taken over at 12, 12.50, you're going to realize a loss. So what do we do? Do we buy a call spread? Maybe, that would be better. Okay, we're buying the 9, but on the back month, and in the front month we're selling the 10. Okay, that would be better. That would give us a max loss of 70 for a profit of 172 and a 52% chance of a profit. Okay, which is like owning the stock. So you're owning the stock and you're getting a better risk, like a 2.5 to 1 risk reward ratio if you just buy this call spread in different time frames, a calendar call spread. Okay, this is the key, because while doing it this way, you will have a slightly positive theta. Okay, this is what you want. The reason why we're doing it on 2 different time frames is because we wanted this to expire worthless, so we can collect the full, let's say, 20-cent credit, okay, on it. Okay, this is what we want to do, and then keep the 9 after for a potential bigger win. Okay, however, here you are capping your win at 3 to 1 or 2.5 to 1, let's say. Okay, so even if it gets taken over at 15 or 12, you will make the same amount of money. Okay, 136, not bad. Okay, but here's one structure that I like that I've been playing around with. Okay, a straddle, but ratioed 3 to 2. Okay, so here you have a much better payoff. Okay, you get the benefit of, like we mentioned, look at the positive theta. So you will make money as this option expires worthless if it stays below the price, below August 28th, but you're not giving up any upside like we did with the just a calendar straddle. Okay, so by ratioing it, by buying more than we are selling, we are going to benefit from the upside. Okay, and with this structure, we have a maximum loss of, per 3-2 structure, we have a maximum loss of 90 cents if there's no takeover. But if there is a takeover, we have big upside. Okay, so 90 cents would be the downside, and we can get 90 cents if the stock trades around 10.50. But if the takeover is at 12.50, we'll make about 270 per structure, and if it gets taken over at 15, we'll make 500. So that is a much better risk reward than doing the simple call spread. Okay, which was here, a calendar call spread. Okay, even a simple call spread is not worth it, because what we wanna replicate is the chance of profit has to be higher than 50%. We don't want like a 30% or we want it to be just like the stock. Okay, so the chance of owning a stock, the chance of the price going up or down when you own a stock is 50-50. It's like it's a what do you call it? A slope of 1 for 1. Okay, so there's a 50% chance of going higher and a 50% chance of going lower. That's what we want to do with our ratio calendar straddle. Okay, and that's what it gives us a higher chance of profit than owning the stock. Our break even is like the stock can actually go down by 2.2% from 866 and we still make money. Okay, and our max loss is set at 90 and our max profit is whatever the takeover price is. Okay, if it's higher, like if we go higher, let's say here, 1620 doesn't go higher than 100%. Okay, so you can go much higher. So if the takeover is at 15, you'll make $500. Okay, and you only risk 90. Okay, and if the stock stays flat, you're gonna make money. You're gonna make $27 if the stock stays flat. Okay, so that's the beauty of this straddle that I like to employ sometimes. Okay, this is a very unique situation. I will not do this on most trades. It's not beneficial, but because there are other factors involved, it gets a little bit more advanced. So what I really like about this is that it's the best of both worlds. You have the exposure of a stock, you have the upside if it goes higher, and you're not capped on the upside, okay? And your downside is limited, and the chance of profit is 55%, which is greater than just simply owning the stock. And your break even is 2% lower. You can still make money if the stock is flat, okay, which is great. So that's what I like, guys. That's how I would play Wendy's. Okay, I don't like the stock. I wouldn't buy the stock. So I would play it in an option structure to take advantage of what options allow you to do, which is take advantage of theta decay and potential upside on the takeover. Okay, and you're down. Your chance of profit is just as high as owning a stock slightly higher with a better risk reward. Okay, and those are the kinds of plays that I like. Okay, so that's how I would play Wendy's. That's it, guys. SPY. The inflation numbers came in great, forming a bull flag. So we have to wait. We have to just wait until this plays out. I just don't like, the one thing that I don't like is these calls. Okay, they have to expire worthless to me. I don't know, maybe these are short-term calls and they expire worthless on Friday, then it's back to neutral, who knows? But for me, that's the only negative thing that I see. And of course, the inflation, the Fedwatch tool. I love the fact that now we're at 25% chance from like, it was 10 and then 18 and now 25% is slowly going in our favor as reality sets in that the Fed is probably not going to raise rates with job losses and, inflation not really high. Okay, so I love that setup. And of course, Wendy's, we talked about it. This is the structure that I like, a 3-2 calendar straddle. That's all I have to say. And these are the expiry dates that I like. Okay, the 28th and the 18th. All right, guys, so that's it. Let's see what happens for the rest of the week. I think we have PPI tomorrow. Okay, I'm not quite sure. I think so. Anyways, let's see how the week ends. Later.